Hi everyone, it's Logan with Hazeltine LLC, and today we're going to look at a case study of term versus whole life and how they compare with each other. Again, this presentation is for informational purposes only, not for investment, legal, or tax advice. And in general, we help people become their own bankers using the infinite banking concept. Okay, so we're just going to look at a fairly generic term versus whole life comparison. And this is pretty standard. This again has nothing to do with the infinite banking concept per se. We're just looking at understanding the differences between term life insurance and whole life insurance and how they compare with each other. So term life insurance is like renting, in this example, a $1 million death benefit, and whole life insurance will be owning the $1 million death benefit. So think about it similarly to when you go to find a place to live. You can rent a home or you can buy a home. And the way in which those compare is somewhat similar, somewhat analogous to the way in which term and whole life compare. So let's look at a 10-year term. Okay, does that have long-term care protection? No, it's just straight up pure life insurance. Does it protect your insurability? No, it does not. If something happens to your health over the course of that 10 years, then when the 10-year term expires, you are left with no options. Probably you won't be able to get life insurance at that point. Okay, so in year one, we're going to purchase a $1 million death benefit. This is a 10-year term. That's going to cost us $230 a year. Okay, this is for a 35-year-old male in good health. And of course, we get no cash value. Term life doesn't grow a cash value, so it's just straight up pure death benefit protection. So it's pretty straightforward. We're paying $230 a year to rent a $1 million death benefit. So if something happens to us over the next 10 years, our heirs would get a $1 million death benefit. So we are temporarily protected in the event of something happening to us. But it does not protect us against long-term care. So if you should have some form of a long-term care need, this policy wouldn't protect you against that. And it doesn't lock in your insurability. So that death benefit only lasts for 10 years. After that, it expires. And if something has happened to your health in the interim, you will not have the option to renew that term because you'll have to go through underwriting again. So we have a temporary death benefit, $1 million of coverage covering us for 1 year. And the cost for that is $230 a year. Pretty straightforward. So looking at that over the course of 10 years, we pay $230 a year. So it costs us $2,300 over 10 years to rent that $1 million death benefit. Okay, now at the end of 10 years, our 10-year term has expired. So now we need a new policy. And there's a risk that we may not be insurable, or perhaps we're only insurable at a higher rate. Now in this example, I'm going to make the assumption that we're still extremely healthy and we still get the best rate. But of course, that is an assumption. There's a risk that we might not be insurable. So now we have a new premium, $555 instead of $230, to get another 10-year term to last us another 10 years. All right, and so now cumulatively in year 11, we've paid $2,855. That's from the $2,300 from the previous 10 years, plus the new $550 premium in year 11. And now over 20 years, we have that $1 million death benefit. We've paid cumulatively $7,850 over the course of 20 years. Again, we were 35 years old when we started this term policy. So now we are 55 years old. Our second 10-year term policy has expired. Now again, we need a new policy. There's a risk that we're not insurable or insurable at a higher rate depending on our health. Okay, so we may not be able to get life insurance at all. We may also have had some form of long-term care event, which can be obviously financially devastating. We're not protected against that. But we're going to assume that we're still healthy and we're still getting the highest rate. So now we're going to get another 10-year term, and the new premium for that one is $1,577 annually. So now in year 21, we've paid cumulatively $9,427, and we've got 21 years of coverage with that $1 million death benefit. So now going all the way out to age 65, that's 30 years, so from age 35 to age 65, we had that $1 million death benefit. There was some risk of us not being able to renew it because of our insurability potentially being at risk. But assuming we're still perfectly healthy this whole time and we get the best rate, we paid in total $23,620. This also doesn't take into account inflation or anything like that. It assumes that the rates that are in effect today will still be in effect 30 years from now. So we're having to make a lot of assumptions here. So we paid $23,620. We got that $1 million death benefit, and now it expires. So we paid $23,620 to rent a $1 million death benefit in 3 separate 10-year terms. Okay, now at age 65, we have no life insurance, we have no cash value, we didn't get anything out of the policy. And of course, if John still wanted life insurance, it would cost even more. He would now be 65 or 66. You can still get life insurance at that age, but obviously it's going to be expensive because now he's much older. So that's the summary of what term life insurance would look like. Now let's look at whole life insurance by comparison. So whole life insurance protects us for our whole life. There is no expiration. So instead of lasting 10 years, it lasts all the way until we die. Does it come with long-term care protection? Yes, it does. Whole life policies typically come with what is called a chronic illness rider, which means that should you have some form of long-term care need, or should you be diagnosed with a terminal illness, in either case, you can advance yourself a portion of the death benefit to pay for whatever costs you may incur. Long-term care is a huge deal. As Tom Hegna says, if you don't have a long-term care plan, you don't have a retirement plan, right? That long-term care need can blow up retirement plans pretty easily. So one of the undersold benefits of whole life is that you are protected against that long-term care eventuality. Is your insurability protected? Yes, it is by definition, because we can keep this policy in force until the day we die, no matter what happens to our health. So if we have some problems with our health within the first 10 years of a term policy and it expires, then we cannot get life insurance. Whereas here, we can keep it in force. And the rate stays exactly the same, no matter how old and sick we get. It's also important to point out that $1 million is not enough. If you only have $1 million of life insurance, you're almost certainly underinsured. At age 35, you need 30 times your gross annual income in life insurance. So if you make $100,000 a year, you need $3 million worth of death benefit. That is your human life value. That would get you fully insured. But just to keep the numbers a little easier and simpler here, we are comparing a $1 million death benefit. But in almost every case, you're going to need more than that. Okay, so the premium for this policy, I just want to point out, is completely flexible. Okay, when people ask what does it cost, the answer is it depends, and that premium amount can vary wildly, just so you know, because I can design the policy so many different ways. There's a ton of flexibility when it comes to how I design a whole life policy. So in this case, we're paying a $16,000 premium, and you can see the death benefit isn't quite $1 million, but close, as close as I could get it. I could make that premium be less or more, just depending on how we design the policy. So it is not accurate to say $1 million of whole life costs $16,000, right? Even if we normalize for age and health and gender and all that. So it really is a very flexible vehicle. So the cost is less important because it's so flexible. We can make it cost whatever you want, okay? So it's important to understand that. But in this example, I just kind of picked a design. So this is a design for whole life that we could do. It may not be the right design for you in your specific situation. Everyone's a little different, which is part of the beauty of whole life. There's a whole lot of flexibility in how we could design it to meet your specific needs. But in this example, we pay in a premium of $16,000 in year one, okay, and we have a little more than $1 million death benefit. That is a permanent death benefit. In fact, one checkbox I probably should have added was legacy planning, right? If you take out a 10-year term life insurance policy, you have not taken care of your legacy planning needs. If you take out a whole life policy, this does potentially take care of your legacy planning needs because that $1 million death benefit is permanent. It will be paid out, okay? That will be an inheritance to someone, all right? So we have long-term care protection, our insurability is protected, and we have legacy planning as well covered here. But what I want to point out is, notice the net cost to us is actually not $16,000 because in that first year we're going to have cash value. As soon as we pay the premium, we're going to have cash value available to us. So we pay in $16,000, but then we have $8,521 of cash value. This is one of the things that makes whole life unique. The reason why a whole life insurance grows cash value, whereas term life insurance does not, is because basic financial principle, a future payment has a present value. Because that death benefit is permanent, we know it will be paid out. Therefore, that future death benefit has a present value. Cash value is the net present value of that future death benefit. So the net out-of-pocket outlay to us in year one is not $16,000. It is $7,479 because of that cash value. So in year one, obviously you can see whole life is more expensive, no question about that, because we're getting so much more out of it, right? But there's no question that in year one, whole life is more expensive than term life, and it's significantly more expensive. Now fast forward out to year 10. Notice our death benefit has grown some. With every premium payment we pay into a whole life policy, the death benefit goes up. Similar to the way that, again, if you buy a house, you benefit from that house growing in value, okay? Same thing here. The death benefit grows in value. You can think of the cash value like your equity position inside of your house, right? So when you first bought that $1 million whole life policy, right, you bought a $1 million house, okay? You have a $1 million asset, you own it, you control it, it's yours. Your equity position in the $1 million house, though, is not going to be $1 million when you make that first mortgage payment, right? So in this example, in year one, our equity position was $8,521, okay? Now fast forward to year 10, okay? We have been paid interest and dividends, which helps grow our cash value, and we've been paying those premiums in as well. So both the death benefit and our equity in the house, so to speak, our cash value has gone up. So we've been paying that $16,000 every year. That means over the course of 10 years, we've paid into the policy $160,000, okay? But we now have $172,000 worth of cash value. So what is the actual net cost to us? Well, on net, we haven't paid anything. We've received more than what we paid into the policy. So by year 10, whole life is actually significantly less expensive than term life, right? This term life insurance policy, we paid in $2,300. That's the cost to us. On this whole life policy, we received almost $13,000 more than what we paid into it, okay? So on net, the cost to us, if you will, is actually negative, okay? And the beauty of the cash value is that we can borrow against the policy using what's called a policy loan, which we never have to repay, while we let the cash value keep growing for us. Analogous to the way you can borrow against your house while you keep benefiting from the capital appreciation in the house, and you keep benefiting from, let's say, rental income if it were a rental property. You can do the same thing here. You benefit from capital appreciation. That is a guaranteed interest rate that the insurance company is paying you, that they're guaranteeing your cash value will go up at a certain rate from now until the day you die. Just think about that for a second. How many assets out there do you know that will guarantee you a certain interest rate, no matter what happens in the market, no matter where interest rates are, no matter what the S&P 500 is doing from now till the day you die. It's pretty impressive. Okay, and then in addition to that, we're collecting rental income. That's the dividend, because this whole life policy is what is known as a participating policy with a mutual company. So you get paid a dividend, which also goes into the cash value as well. So the net is, at the end of year 10, we have our death benefit has grown. We have more than $1 million death benefit, and our cash value has grown to be more than the cumulative premiums we have paid into the policy. And of course, this whole time we're protected by that death benefit. Should, God forbid, something happen to us, we have long-term care protection, and our insurability is protected. We can keep the policy in force no matter what happens to our health. And just to recap now, unlike with a term policy, we don't have to apply again. We already went through underwriting. We don't have to do it again. It doesn't matter what our age or our health is. We're going to be paying the same exact premium as before. So we have the guaranteed right to keep this policy in force. We would not have to go through underwriting at this point. So obviously there's no risk no matter what happens to our health. This is what we mean when we say our insurability is protected. Okay, year 11, we're paying that same $16,000 premium. Now our cash value has grown to $198,000, so we're positive by $22,000. So continuing to get better. Fast forward to year 20. Now notice our death benefit has grown to almost $1.3 million. We have almost $500,000 in cash value in the policy. So on net, we've received over $170,000 more in cash value than what we paid into the policy. Now in year 21, right, we're now 55 years old. Are we still insurable? Well, we don't know. Are we even insurable at the best rate? I don't know. Maybe we're still insurable at a different rate. Well, that all doesn't matter if we have whole life, right? We don't have to go through underwriting again. We are locked in. We'll be paying the same premium, right? And we keep the policy in force no matter what happens to our health. So year 21, we keep paying that same $16,000 premium. We can see how our cash value has grown. I want to point out that when you make that $16,000 premium payment, your cash value is growing by more than $16,000 every time you make that payment. And it's significantly more, and it gets better every single year. So if I give you a magic bank account where every dollar you deposit into the bank account gives you $2 worth of account balance growth, how many times are you going to make that deposit? Notice from year 20 to year 21, our cash value grew from $491,000 to $532,000. I'm not very good with arithmetic, but I think that's what, $40,000? Something like that, right? $41,000. So think about that. In year 21, you paid a $16,000 premium, and your cash value grew by $41,000 immediately, with no market risk and no taxation. Just the power of compound interest backed by actuarial math. Let me say that again. Year 21, you pay a $16,000 premium. Your cash value grew by $41,000. Why would you not make that premium payment? Right? This is why asking what a whole life policy costs is such a misguided question. Right? This is what Brent Kessler calls the broken vending machine dilemma. Right? In year one of a whole life policy, you have a properly working vending machine. You pay $1 in, and you get your Coca-Cola. Right? The Coca-Cola is the death benefit. The dollar you pay in is your premium, but you don't get the dollar back. You got the death benefit. Okay? Fast forward in this example to year 21, you pay that same dollar in. You get a larger Coca-Cola, right? The death benefit has grown. And the machine spits almost $4 back at you, right? The machine's broken, right? You got the death benefits you paid for, which has been growing, and you got more back in the same year than what you paid in. And that gets better every single year. That's the way these policies work. So that's important to point out. Why would you not want to pay a $16,000 premium if your cash value balance grows by $41,000 when you do that? Looking at that $16,000 as a cost is not the right way of looking at it. So now in year 30, we're age 65. Our death benefit has grown to almost $1.7 million. So getting back to the house analogy, when we bought the house, it was worth $1 million. Now it's worth $1.7 million. When we bought the house, we had very little equity, $8,500 in year one. Now we have over $1 million worth of equity, cash value, in the policy, right? So we bought that $1 million house for an initial $16,000 mortgage payment. Okay, we've kept making that $16,000 annual mortgage payment. Okay, and now, so over the course of those 30 years, we paid $464,000 into our house, right? But the house is now worth $1.7 million, and our equity in the house is more than $1 million, right? So on net, we've gained more than $500,000 worth of cash value in the policy. Okay, so again, when you ask what a whole life policy costs, well, the short answer is it depends wildly on how I design the policy. I can design it all kinds of different ways. It's really more about what are you trying to accomplish with this policy, and then we can come up with a design that makes sense for you. Okay, but always you are going to get more out of the policy than what you pay into it, either because, God forbid, you die prematurely and that death benefit pays out, so your heirs get significantly more than what you paid in, or you keep it in force and the cash value just keeps on growing and greatly exceeds whatever you've paid into the policy. Okay, similar to the house, again, we get so many benefits out of this, right? Mainly, what's not shown here is the policy loan feature, the ability to borrow against the policy without interrupting the compound interest and dividends you're earning inside the policy. And compound interest gets better every year. These policies get better every year. They age like a fine wine. Okay, every single year they get better. And we're not taking on any market risk here, and we're not paying any taxes because it's all inside a life insurance vehicle. And if we use the policy loan feature, similar to borrowing against your house, there's no taxes due because we're not realizing a gain. We're just borrowing against an asset that we have. And the policy loan is not a debt. Okay, policy loan has no repayment terms on it whatsoever. You never have to pay a dime of it back if you don't want to. It's totally up to you. You can pay it back if, when, and how you please. But again, on net, we're seeing that over the course of 30 years, our death benefit has grown to $1.7 million. We have over $1 million worth of cash value in the policy. We're protected against long-term care. Doesn't matter what happens to our health. We can keep the policy in force and the premium stays the same, doesn't go up, right? And we have plenty of options. So now, if we want to retire at age 65, okay, I'm not showing all the details here, but it's important to understand when we say we have $1 million in cash value, okay, you can actually get a lot more out of it than that because of your ability to borrow against the policy without interrupting the earning in the policy, the same way that real estate investors will leverage their properties. So I'm not showing the illustration and all the numbers here, but in general, one of the things you could do, and there are lots of different ways you could do this, we could draw $1 million in tax-free income over the course of 20 years by strategically taking out policy loans. Okay, so from age 65 to age 85, we could draw $1 million in tax-free income, and we would have, at the end of that, at age 85, we would have $1 million in cash value left over and still $1.1 million in death benefit left over, right? So typically, we can get a lot more out of the policy than you would think just by looking at the cash value, because again, we're going to access it not by withdrawing money, so to speak, but by taking out policy loans while we still let the entire full principal balance keep compounding for us, right? And that compound interest gets better every single year. So we can borrow against it while the policy still keeps earning at a faster rate than our borrowing, okay? Also think about the importance of having that permanent death benefit as you approach retirement, right? You know your legacy planning needs are taken care of. right? In this example, you're going to have $1.1 million of residual death benefit. So what it does is it gives you a permission slip to spend the money that you have more freely, knowing that you have this permanent death benefit that's going to take care of your legacy planning needs, right? You don't have to worry about what you're going to give to the children and the grandchildren. You already took care of that, okay? And of course, all this stays in force no matter what happens to your health. So this is just one very generic example of how term life compares to whole life. And I think what I'm trying to show is that if you ask what does it cost, it's not a very relevant question because it's not an apples to apples comparison, right? What you get from whole life is very different from what you get from term life. And of course, what whole life actually costs depends on how you design the policy, right? Even if you have someone who's exactly the same age, gender, and health, okay, I can still make that cost, quote unquote, that premium vary wildly depending on how I design the policy. And how I design the policy depends on you and your specific needs, okay? But in general, you can see with a term life insurance policy, it cost us over $23,000 to keep that policy in force for 30 years. There's no guarantee that we could keep it in force, okay? And there's no guarantee that those rates won't go up, all right? And then at the end of 30 years, we have no life insurance, no cash value. We got nothing out of the policy, okay? The way some people would say it is when your $1 million term life insurance expires, your estate just suffered a $1 million loss. That's really the way to think about it. With whole life, there was no net cost. We actually gained more than $500,000 more than what we paid into the policy. We now have a $1.7 million death benefit and over $1 million in cash value that we can use. And thanks to the policy loan feature, we can draw really over $2 million worth of tax-free cash benefits out of the policy and still leave a residual $1.1 million death benefit left over. Plus, we were protected against long-term care needs. And of course, our insurability is locked in. We can keep this policy in force no matter what happens to our health, no matter how old and sick we get. And now I want to look at an interesting, what I call in-between option, just to let you know there actually is another interesting option. It's called a convertible term policy. Okay, so I mentioned a term life insurance policy is like renting life insurance. Whole life insurance is like owning. Okay, a convertible term is kind of in between. It's sort of the rent to own option. Okay, so in this example, we're going to look very briefly at a 10-year term policy with the guaranteed right to convert it to a whole life policy over the course of those 10 years. And you can convert it in increments. So you don't have to convert the whole 1 million all at once. You can convert it in increments if you want to, okay? So does the 10-year convertible term policy have long-term care protection? Yes, with qualifications, right? If you have some form of long-term care need and you still have that term policy in force, guess what you can do? You can convert it to whole life and there will be no underwriting. And now you have that long-term care protection in force. Think about how great that is, right? How many insurance policies will allow you to buy insurance after the home burns down, right? Well, that's what this is allowing you to do, right? If you develop some form of a long-term care need while that term policy is in force, you have the guaranteed right to convert it to whole life. And as soon as you convert it to whole life, you can advance yourself a portion of that death benefit for a long-term care need, right? So that's actually really important. So yes, it does give you some long-term care protection potentially. Does it protect your insurability? Yes, again with qualifications. The qualifications to both of these is it only does it for 10 years. So your insurability is protected for 10 years. So let's say you're 5 years into a 10-year term policy and you have a bout with cancer, right? You'll probably survive, but now you may not be able to get insurance or it might be at a much higher rate. But now you have options. As long as that 10-year term policy is still in force, you can convert it with no underwriting. So now you have options. So yes, your insurability is protected at least for 10 years. Okay. When we look at this, this is what a 10-year convertible term policy would cost. $254 a year. Okay. So in this example, it's only $24 more annually than straight up term, right? This is why, in my opinion, taking out a convertible term policy is a no-brainer. If you're going to buy term life insurance, I would recommend buying a convertible term policy with a company that has a competitive whole life product, and that narrows it down to a few. Okay, you want to be working with the right companies. Okay, so you don't want a term policy that has no conversion privilege, because that doesn't protect your insurability and it doesn't protect against eventual long-term care needs. Okay, and you can see the cost is not that much. Now, granted, to make this an apples to apples comparison, I'm comparing term and convertible term with the same carrier. Okay, so you probably could find cheaper straight up term options out there, but that's because you get what you pay for. Okay, I'm trying to make it an apples to apples comparison. So you can see with this carrier, if you want a convertible 10-year term policy, it only costs $24 more per year. That's $2 more per month. I think that is more than worth it, given how many options that this gives you, given how it protects your insurability. So convertible term is the in-between option, and it gives us optionality. It gives us options. And when I'm working with a client, usually what we'll do is we will start with your total insurability, because we want you to be fully insured. Let's say your total insurability is $3 million, okay? And then we come up with an infinite banking style whole life policy that makes sense for you. And let's say that has $1 million death benefit, okay? That means we have $2 million of insurability left over. What are we going to do? We're going to supplement that $1 million whole life policy with a $2 million convertible term policy. So now you are fully insured, okay? And when it comes time to expand your infinite banking system, you're just going to be converting that term that you already have in force. So of course, all this depends on your situation, but usually where we end up is with a blend of specially designed whole life insurance policies that you can use to become your own banker, supplemented with term policies that get you fully insured, take care of your life insurance needs, and lock in your insurability, and reserve your spot in line for the future when you're ready to start expanding your infinite banking system with new policies. So convertible term policies can be a very important part of your overall financial strategy when it comes to life insurance and beyond. This has been Logan Hertz with Hazeltine with another video here. Thank you so much for watching. I look forward to speaking with you.